coach for 3 years, and I've written personal finance material, blogs, appeared on podcasts and things like that for probably six or 7 years. So I've been really just interested in personal finance and financial education for a long time, because I really feel like I've been that person who was kind of not sure what they were dealing with and what they were doing, and I found out that it's a lot easier than we're led to believe a lot of times. So I love going out and doing these presentations, because that allows me to share that knowledge and share that experience with others, and hopefully give you the same sense of satisfaction and peace and understanding about financial education that I've got. So I live in South Jordan, so out in Daybreak, if there's anybody South Jordan local, then we're neighbors. But otherwise, I'm going to kick it off here with Credit Myths Busted, which is our look at some of the major things that you hear about credit and credit scores, and some of the misunderstandings that often accompany those conversations, and try to set you straight, give you some good information so that you really understand what the truth is, and what the things are that you need to pay attention to. So with that, let's start off with kind of what we're going to hit during this conversation. So we will talk about the credit basics. We're going to talk about the components that go into making up your credit score. We will talk about risks to your credit, how to maintain and restore your credit, and then your rights as a consumer when it comes to credit. So with that, let's get to first off our credit basics and our very first myth, which is that your credit score is one number. A lot of times you'll hear people talk about how they want to increase their credit score, and their credit score is, 620 or 715 or something like that. Well, what is a credit score even when we're talking about credit scores? It's really just a metric that the companies who are putting together information for lenders, they make this to say, basically, are you somebody who's likely to pay back a debt? So if somebody loans you money, what is the likelihood that you're going to pay that money back in the agreed upon terms of that loan? And that's really what the credit score is when it comes to what a lender's looking at. So the first credit score was the FICO score, and it actually came out in 1989. So a lot of times we hear about credit scores as being this, this huge thing, and we probably think it's been around forever, and it hasn't really. It's been around for a while, and it is a big deal, but it's relatively a new concept. FICO stands for the Fair Isaac Corporation. That's the company that created this system that is most frequently used today. That's kind of the, gold standard when it comes to credit scores, is the FICO. And what the FICO does is basically, like I said, predicts how likely you are to repay your loan. And the scores range anywhere from 300 to 850, depending on which score is being used. And most of the time you won't see scores, down in 300. That's really not something you'll see frequently, but going up to 850, that's pretty common as the top end. And then there's also some proprietary systems that other companies may use on their own that might be a little bit different as well. So when we're talking about a credit score, there's actually different scoring models. And so that's why our first myth is wrong, in that your credit score isn't just one number. It depends on what the particular scoring model being used is. So it could be FICO, it could be Vantage, it could be a company's own proprietary model. But then also each of those has different variants of their scoring system. And so you might have somebody who's using a FICO 8 and somebody else is using a FICO 5, right? And so depending on the system that they're using, that is going to weight certain things differently and provide a different score. So let's take a look at an example where you may have some differences. One single person might have differences, right, in their credit score based on which model's being used. The credit reporting agency, so there's 3 different main credit bureaus: Equifax, Experian, and TransUnion. And each of those may have slightly different information because not every lender will report to all three bureaus, or they may not report to all the bureaus at the same time. And so you may have differences in your score based on whether a scoring system is using Equifax or TransUnion or Experian's database, or a combination thereof. So for some examples there, you could see on the right-hand side, if you had somebody who had a 740, maybe Mountain America used Experian and the FICO version 2, right? And maybe in example B, you've got somebody with a 722, another bank used TransUnion and FICO version 8. So you can just see why there might be differences in the scores based on what version and what credit bureau reporting agency there is. So when we're talking about the scores themselves, what do those numbers even mean? What does it mean to have a 720? Well, let's start off first with what it means to be an exceptional credit score. If you have an exceptional credit score, you've got greater than 800. This is usually for people the easiest approval process, because you've got a history of showing creditors that if they loan you money, you're going to pay it back on time in the agreed upon manner. And so their money is at very low risk when they lend to you. And so if you have a credit score greater than 800, you're going to qualify for the usually best rates, the best terms, and really don't have to usually prove a whole lot in terms of your ability to pay that loan back, because your credit score is so high. More common for a lot of people is the very good range, from 740 to 799. And this is usually just about as good as exceptional. There aren't very many places where you're going to notice a difference between the treatment that you're going to get as somebody who has a very good credit score versus somebody who has an exceptional credit score. So if you're over 740, just about anywhere, you're going to get the best terms, the best rates, kind of the best path forward in getting a loan. Now, if you're somebody between 670 and 739, that's more of an acceptable borrower. So somebody who's good, right? In this case, chances are you're still going to qualify for very good rates. You're going to get good terms. You may have to provide a little bit more documentation, or they may do a little bit more thorough background check on some of your financials before they extend those. But generally speaking, with a 670 to 739, you're going to get fairly good terms and qualify in many cases for a loan. When you start to get into this range here of 580 to 669, this is where you're considered a subprime borrower. You might have heard that term. Somebody with a fair credit score, they're going to qualify, but they're usually going to have to either deal with higher rates on their loans, or they're going to have to deal with some more hoops to jump through, some more restrictions as far as how much they might be able to borrow versus some of those people who have higher credit scores. And then when you get below 579, this is somebody who's considered in the poor range of credit. These are likely people who are going to be rejected for credit applications, or they're going to get really unfavorable terms. They may have to have things like deposits when they go and take out utilities, for example, or they might have higher rates on things like insurance. That's one thing that comes up sometimes is, creditors can use your credit score for different reasons. And if you have the lower the credit score, then the more chance there is that you're going to be negatively impacted in different ways by that. So let's talk about myth number 2, and we just kind of touched on it a little bit. Myth number 2 is that your credit score doesn't matter unless you're applying for a loan. Well, that's not actually true, because yes, lenders can view your credit score when they're making a decision, but also landlords. If you're going to go out and rent, typically there's a lot of landlords who are going to pull your credit score because they want to see what's the likelihood that you're going to pay them when rent is due. So that can affect you. Potential employers can as well, depending on the type of job you're going to do. They might check your credit score to see whether there are any issues in your financial history that might be a conflict of interest or something like that. Insurance companies will check your credit score, so you can end up with higher insurance rates if you have a low credit score on things like homeowners insurance or auto insurance. And then another myth is that your credit report is a secret and you can't see it. And that's absolutely not true. And that's been less of a myth in the past, I would say 5, 6, 7 years, as more and more people are getting comfortable looking at their credit report online, signing up for some of these services that will monitor your credit report, give you alerts, that sort of thing. I'll tell you, if you're not doing that, I really highly recommend it. I just had, yes, Credit Karma is one there. Somebody mentioned inside. So here's the thing that you want to think about when you're using these apps to check your own. First off, most of them are using one credit reporting agency. So they might only be using Experian, or they might only be using TransUnion. And so you're not going to necessarily see everything by using one of those. The way that those tend to make money, of course, is they're showing you products and services, and they're using the information that they get from your credit report in order to tailor those products and services so that they're meant to appeal to you more. So that's what typically their business model is. Now, that said, they're fantastic. I will tell you personally, about about a month ago, just before Christmas, I got an alert from Credit Karma to check something on my Experian report. There was some credit, applied for. Well, I didn't think a whole lot of it because I personally had just applied for a credit card, but I decided to go and make sure that that was what the alert was. And there was actually, yes, that alert for when I applied for a credit card with Capital One. There was also an alert that's saying somebody had applied through Chase Bank for a credit card in my name. And I called Chase to find out what was going on. And it turns out that somebody had indeed applied for a credit card in my name using my social security number. And it was that alert that came through that I was able to call and get Chase to stop that application in process. And it never got past the stage of application. And then I went and made sure to refreeze my credit report because obviously there were some things there. So those apps are fantastic in just giving you a heads up that, hey, something is going on. You probably want to look at it. I will say you do get a lot of ads, right? You do get a lot of sort of marketing emails that go along with those, and you can tailor those, of course. But the alerts that can really warn you to something being wrong, that's really worth having. Okay, there's a question about when you first open a credit line, where does your credit sit? So that's going to depend a lot. We'll talk a little bit more about that coming up in terms of what makes up that credit score. Okay, so credit basics here, the importance of credit. You want to have a higher credit score because of just the ability to get credit when you need it. You don't want to wait until you need to ask somebody for money to try to prove to them that they should loan it to you, right? If the first time you're asking for money is when you really need it and they have no history of you, using credit in any way, it's going to be harder for you to qualify, harder for you to get the best interest rates or the best insurance rate, that sort of thing. But it's something that you don't want to kind of wait just because you can. You want to try to start early there. So let's talk about this, the components that go into it, and we'll hit this. We'll hit this question here that just came in, I think, as part of this. So first off, on your credit report, which I said you can go and get, and you look and see, first off, they're going to say what kind of information they have on you, your identification. You're going to look for names, addresses, phone numbers, anything like that. I apologize. My cat is making all kinds of noise to get out of this room right now. Let me do that so that you don't have to hear my cat meow. through this whole presentation. Just a second. All right. So what you want to look for on there is, first off, are the names that are appearing names that are yours, right? If you got married, you'll see maiden names. If you've changed your name in any way, you should see those. One thing to really be careful about when we're looking at credit reports and names is if you're somebody who has a family name, you're like a junior or senior or a third, that kind of thing, make absolute certain that the things that are on there are accurate, because a lot of times there will be mistakes that will transfer onto the credit report of somebody who's a junior or senior from the other person. And so if that's your case, or you know somebody that's the case, they really want to be careful and pay attention to that. You also want to look for addresses. So if you notice addresses on your credit report that you never lived at, that could be a red flag that maybe there's some fraud, right? Somewhere along the line, there's been a record of you living at that address, or you having some property of some kind at that address. And so you want to find out what's going on there. Obviously, your date of birth, make sure that that's right. And then telephone numbers, that's one where you can say, have I ever had these telephone numbers? Are they, sometimes you'll get business numbers might show up there. Any number that in public records has been associated with your name is going to show up there. Sometimes those can be wrong too. You'll get some oddball ones. That's a little bit less concerning usually, but still something that you could check out if you're worried that there might be some sort of fraud on your report. Employment history. So it will sometimes show the employment history on there, but it's not going to show, your salary or anything like that. That's not going to show up on here. They don't have that kind of information in your credit report. Public records. So public records that are going to show up on there are going to be things like bankruptcies, tax liens, judgments, lawsuits, things that have a financial impact on you. I don't think, generally speaking, you're going to see every, you're not going to see like traffic tickets and things like that typically, but you're going to see the major ones, the things that might be a problem for somebody who's interested in figuring out whether they should loan you some money. It's a great question, Brittany. We will hit that in just a minute. Trade lines. So trade lines, when you look at that, that is anybody who's got an open line of credit with you. So you're going to see everything that you've ever had open as far as credit in your name. It's going to be credit cards. It's going to be loans. It's like auto loans, mortgages, student loans, payment plans, anything like that that has been reported to the credit agencies as a line of credit is going to show up there. And it's going to show up with all of the information, things like the account name, number, possibly, when the data was opened, what the status is. So is it a current open line, or is it something that's been closed? Or is it something that's been sent to collections, that sort of thing. You're going to see a payment history, and that's a really important part when you look at that. So there's a question earlier about if you had a late payment but you paid off the loan, why does the loan fall off but not the late payment? So really what they're showing here is your payment history, right? Just because you paid off the loan doesn't necessarily mean that you did a very good job of it as far as the creditors are concerned. So if you had one late payment, that's probably not going to be a huge problem for most lenders. But if you have a track record of inconsistent payments or consistently late payments, just because the loan is paid off, the creditor is interested to know, well, if I go and open a new loan with you, what can I expect? And so that's why if you have late payments, those are going to stay on your credit report, even though the loan itself might be, completed and closed. It's still showing what's your history with that group. So again, this is an area as you go through your credit report that you really want to pay attention to, because if you don't recognize a trade line, if there's something on there that you see that doesn't sound familiar, that's a huge red flag. That's something you want to look into, and you're going to want to take action around. And then lastly, you're going to see inquiries, and inquiries come in two flavors. So there's a soft inquiry, which is just somebody checking your credit report for information, basically. This is the same thing that happens when you yourself, like when you go and open a Credit Karma account, they're just doing a soft inquiry. When you get those things in the mail that are, you've been pre-approved for this credit card, that comes from a soft inquiry. Soft inquiries don't affect your credit score. That's an informational item where they're just saying, this person, this agency, some group has pulled your credit in some fashion in order to get information, but it's not because you came to them and said, I want you to loan me money. When you do that, those are called hard inquiries. And a hard inquiry does affect your credit score. Hard inquiries are where you're going out and saying, I'd like to apply for a loan. And the lender is saying, great, I'm going to pull your credit score and see what we're looking at and let you know. So that was the warning that I got from Credit Karma, was somebody has placed a hard inquiry on your report. And that's what caused me to go and look and make sure that it was the one that I thought it was, and to find out that it wasn't. So anytime you have a hard inquiry on your report, you want to make absolutely certain that it comes from a group that you requested look into your credit so that you could maybe take out a loan, whether it's a car loan, credit card, anything like that. Okay, so myth number 4, if you make more money, you'll have a better credit score. Well, not necessarily, because the amount of money you make actually doesn't have anything to do with your credit score. So the 3 factors that have the highest bearing on your credit score, first off, is that payment history. Payment history makes up 35% of your overall score. And so this is the biggest thing that people really need to understand, is just because you made payments, if you're not paying them on time consistently, that's going to have a huge impact on your credit score. So one thing that I know often will happen to people is they'll get a notification, or they'll know that their credit card, is coming up due. They know what the due date is, and they just space it, and then they get the, hey, you're late email basically, and they run it and they go and they pay it. And that will show up as a late payment. If you do that enough, your credit score is going to take a dive, even if you paid it the day after. So what I always recommend for people, in order to make sure that that isn't a problem for you, is if you can set up an automatic payment for the minimum payment, then anytime that date comes up, if you haven't already scheduled a larger payment, at least you're going to be saved by the $25 auto payment that's going to hit on time, and it's not going to ding your credit score. And then you can go in, and when you get the your payment has posted email, go, oh my gosh, I forgot to pay what I wanted to pay, but thankfully you'll have paid the minimum, and so that will keep your payment history from going down and hurting your overall credit score. The second biggest factor is the amount of debt owed. And so this comes in a couple of things, right? So it's not just the amount of debt owed in total, it's also how much of your available credit you're using. So there's credit utilization aspects of this too that come into play. So, you might owe $5,000, and if your $5,000 is 100% of your available credit limit, if you've only got one credit card that's got a $5,000 limit, then you've maxed out your credit limit, and that's going to look not good. But if the $5,000 you owe is just a drop in the bucket, maybe you've got $75,000 worth of available credit, then that's going to look less of a problem than somebody who's only got $5,000 worth of credit available and owes all of it. So keep that in mind as well. And I think that's 30% of your overall score. Then your length of credit history is about 15% of your score. So what that is how long have your credit lines been open, and how long does your payment history go back? So if you've got a credit card or something, the very first credit card you opened, a lot of times people will open starter cards, things like that. And over time, they may not really use those cards anymore, and they might go look to close them. And I would encourage you not to do that in most cases if it's your oldest credit line. You want to leave your oldest credit line open, assuming that there's no, real big negatives about it, because that keeps your length of credit history um, extra long in the credit scoring system. So if you close all of those accounts that are old, and then the length of credit history is a little bit is skewed because it's more of they take an average of the length of credit history. They don't just say, oh, the first time you opened anything was in this year, and so that's how long you've been using credit. They say, of all the credit you have, what's the average that credit has been open, that line of credit's been open. So that's what they're looking at there. There's two other components that play a 10% part each in your overall credit score. One is new credit. So if you've applied for new credit in the past couple of years, then that's going to factor into your score a little bit and usually bring it down. Although there's trade-offs, right? Because say you've applied for new credit and you've gotten that, you've gotten maybe a new credit card, and maybe it has a much larger balance. So now the amount of money that you owe relative to your overall balance is much less. So you might see kind of a trade-off there, right? You've gotten new credit, but now you've got more available credit. And so maybe your score actually goes up from that. And then the last one is the type of credit. So the mix of credit, basically. Do you have credit cards, auto loans, mortgages, student loans, personal loans? What are the different types of loans that you have? Those will come into play as well. All right, question. Would paying off the balance and keeping open an account be better than closing it, even if it's not the oldest account? I mean, typically speaking, there's not too many negatives to leaving open an account that you're not using, on a regular basis. If it's not costing you an annual fee, if it doesn't have other negatives, and you want to leave it open, you can do that. Certainly, there's more chance that that particular account could be caught up in fraud for whatever reason. So as long as you've got your alerts set and that sort of thing, that would be fine. Let's see, there's a few different sites out there that have tools where you can kind of go in and say, what would happen to my credit score if I did this, if I closed this account, if I reduced my available balance by, X thousand. If you're interested in kind of poking around to see, then you could go and look at those. I would say, depending on the type of account it is, and how long it has been open, there may be little to no effect on your score if it's not the oldest account. So maybe you went to like a Kohl's or something and opened one of their credit cards, just around Christmas because you wanted to get 15% off. And now you're saying, do I really need this card? I'm just going to close it. You can close that, probably not see anything happen really, or it'll be a minor blip, and it'll recover later. So, there's not a hard and fast rule. But I would say if you've got a card that maybe has a large balance or it's a large portion of your overall available credit, I would kind of make sure before I close that one that it's not going to really negatively affect me unnecessarily. You're welcome. Okay, so credit components, time has a huge impact on your credit score. So things that have happened within the past 2 years are going to be weighted more heavily than things that happened, after that. So negative information can stay on your credit report for 7 to 10 years. That is a myth, but it's true. You hear that a lot, right? If I file for bankruptcy, I'm going to end up, not being able to. This is going to stay on my credit report for 7 years. Yeah, it is. It is. The further away you get from that, the less weight it will have, but it's going to stay on there. Um, the things that you want to do, so even if you've got, maybe currently you've had sort of a spotty credit history and you want to clean it up, the best thing you can do is to budget, to pay on time, and to keep doing it for a long time. That's really the simplest way to tell you how to improve your credit score, is just to make sure that you're paying your debts on time for a long time consistently. And if you're doing that, then your credit score is going to improve just by the nature of the way credit scores work. You don't have to make more money to do that. It can really be about discipline and systems. Okay, so let's talk about some credit risks. One of the big ones that comes up a lot, especially for people who have teenagers, young adults, kids, just starting out, that sort of thing, is co-signing. So co-signing is when you basically help somebody who wouldn't otherwise qualify for a loan. Maybe it's a car loan, maybe it's student loans, but you co-sign and say, I'm going to be equally responsible with this person for this loan. And so if you co-sign with somebody and they don't make the payments on that loan, it's going to affect your credit score. And if they really go off the rails and stop paying, that creditor's coming after you next. And so a lot of times people think, oh, I'm just going to help my kid out. I want to make sure that they can get the new car, or whatever it is they want, they can get that. And it's okay. They're going to pay for it. Just recognize anytime you're doing that, you are accepting full responsibility for that loan. You are next in line when the bill comes due and it doesn't get paid. They're coming after you, and you're saying that's okay. So just understand before you go into a co-signing situation what that looks like. Another thing that you want to watch out for are unpaid items, right? So those things can be can be medical bills, doctor bills, utilities, cell phone bills, things like that go to collections, even if they wouldn't normally show up on your credit report, right? So typically your cell phone bill is not going to show up on your credit report, because it costs money for those companies to report those things, and they're typically not they're not loaning you money. But if they have to send something to collections, then that is going to show up, and that's going to show up as a debt that you did not pay on your credit report. And so you just want to be careful, not to let that stuff lapse and think, well, it doesn't matter, I'm just not going to pay it. It could come back and bite you on the credit report side of things. You don't want to max out your credit cards. We talked about this a little bit earlier, right? Credit card utilization. So the higher your credit card utilization, the more of a risk you look like, because it shows creditors that maybe you don't necessarily have a lot of credit to your name, but you're using all of it. And this one can be a little tricky for people too, because different credit reporting agencies will report at different times, right? And so maybe your credit card company reports everything on a certain schedule, and maybe your due date falls just before that schedule. And so when they go to report, it looks like you've got a really high balance, but then you're going to go and pay that whole balance off in full, 3 days later, but they're reporting a very high balance, and that could negatively pull down your credit score. So you just want to kind of look and see if you can gauge, when is my payment due versus when this is being reported, and if it doesn't look like it's being reported that in the way that's most advantageous to you, then you might want to call and say, hey, can I move my credit card, due date so that it's a little bit earlier, or just go in and pay it consistently on time, so that when the agencies do report to the credit bureaus, it shows you as having a low balance or a zero balance at that time, rather than a consistently high one. And then finally, cash advances. So cash advances, you'll often get these checks in the mail. If you have like a credit card, they'll send you these checks every once in a while and say, hey, go and write this check and we'll send you cash for it. You don't have to put it on your credit card. Typically those come with more fees, And the unfortunate thing is they're a sign that maybe you're in some financial straits. And so you really want to try to stay away from using cash advances if you can, because those are not really good for your overall credit usage. Some of the warning signs that you might be a credit risk, if you're only making minimum payments on your debts. So maybe you've got a lot of debt, but you're just consistently only able to make the minimum. That can show up as a warning sign that maybe you're in over your head. If you're at or near your limit on those things a lot, again, that's probably an indication that something's up. You need to kind of look at where you're at, maybe make some adjustments in lifestyle behavior, financial situations, so that you can start to pay down those debts faster. If you don't know how much you owe in total, you don't even have a clue because there's so much out there, that's a big red flag, right? You want to sit down and figure out what you owe, where you owe it, so that you can get a handle on that and start to make a plan to move forward. And then, of course, if you're receiving calls from collections agencies, that's something that should be a red flag, because somebody has sent you to collections for not paying, and you want to make sure that you address that in some fashion. You don't want to just ignore that. Which brings us to our next myth, which is that those companies that you hear on TV and radio commercials can get negative information removed from your credit report and save your credit and make it all good again. Well, that's not actually true. Unfortunately, here's the deal with those things. Those credit repair clinics and a lot of those agencies, one thing they can't do is remove truthful negative information. They can't, if it's true, it's going to be on your credit report. A lot of times what those groups will do is they'll go in and they will argue with the credit reporting bureaus that all of the negative information on your credit report is wrong and that they need to go and investigate it. And by law, they say, okay, we will take it off for 30 or 60 days while we investigate this. And if they come back and say, yeah, we looked at it, it was true, then it goes right back on. So you've paid a bunch of money to this, this company to clean up your credit report. And for a very brief time, it might look like your credit score is improved while they're trying to, verify all this information. But realistically, it's, if it's true, it's not going to go away. So you want to make sure that you're not falling into that trap of thinking that there's a quick fix here. That said, if there's something wrong, yes, you want to get it removed. And you can actually do all of that yourself. There's nobody who can do anything to your credit report that you can't do yourself by contacting the credit bureaus. So try to keep that in mind when you hear those commercials. A couple other things that you want to watch out for: high interest debt consolidations. So a lot of times you'll hear offers for debt consolidation and say, just take all of your different debts, bring them to us. You'll have one easy, low monthly payment. A lot of times what will happen is you might have some debt that has higher interest and some debt that has lower interest. And maybe this debt consolidation loan that they're pushing is on the higher end, right? And so you're rolling all of this money into something that overall is probably going to cost you more. And so you want to be real careful that you don't put yourself in a worse position by consolidating your debt into an even larger interest payment, or consolidating it into a debt that allows you to make a much smaller payment, but then it racks up much more interest because you're putting so much less toward the principal of that debt payment. Rent to own places are another one to watch out for. So typically when you go, you see those like the Rent-A-Centers and things like that. And it's like, here, you can get this, really fancy TV for $40 a month or something like that, for the next 5 years, whatever it is. Typically, you're going to pay somewhere between 2 and 4 times the value of those items when it's all said and done. And so, yeah, maybe it's cheaper, per month. But chances are that's just an indication that maybe you can't really afford the thing that you're looking at there. So you want to be careful with those rent-to-own situations. And those especially can come back to bite you because if you've got any sort of credit scenario baked in with those, then that's going to show up on your credit report that you're using the rent-to-own places. And then lastly, payday loans or title loans. Those are two. If you're looking at those, you really, really, really want to avoid those. They are typically extremely high interest, especially in the state of Utah. We've gotten a lot of flack as a state for not really clamping down on this over the years. Interest rates are something like 400% in a lot of these. It's just crazy in many cases. And so if you're using those payday loans, a lot of times what happens is people get stuck in this cycle where they go and get a loan for something and they just need to get through that, special time where they don't have that money, but the interest is so high that then they have to go and take out another loan to pay off the first one. And it's this cycle that goes through and through. If that's the case, if you know somebody that's dealing with that, you're dealing with that yourself, definitely reach out to us so that we can help you figure out how to get out of that cycle and get you on the right path. There's a question, is there a way we can restrict the soft credit inquiries to make it more private so we don't get as many letters in the mail from the other credit card companies? There is an opt-out site, and then the URL is escaping me. But if you go and do a Google search for like credit card offer opt-out, something like that, you should be able to find a site where you can go and say, please take my name off of the list to be considered for these pre-screen offers. And that will help with that. It won't get rid of everything, but it will get rid of some, certainly. And I can't remember how long that lasts for. I don't think it's forever. So if you've done it in the past, you might need to do it again. Because I think I had done it at one point, and I can tell you right now, I'm still getting a lot of offers this day. So it may not last forever. Okay, so maintaining and restoring your credit. The myth number 7 is there's really nothing that you can do to fix your credit report. Well, we kind of touched on that, right? That's not true. There's a lot of things that you can do to make sure that your credit is better and to make sure your credit report is accurate. So first off, you want to review your credit report annually. Thank you. There you go. optoutprescreen.com. If you go to annualcreditreport.com, you can download the 3 different credit bureau credit reports for you. Typically, it used to be one, you could do that one free per agency per year. Since COVID, they've changed up a little bit. I don't know where it's at right now. But definitely you can at least do one per year. What we used to tell people to do is, every quarter go and pull a different one. And so that way every 3 months or 4 months, you're always seeing, I guess every 4 months, right? Do one every 4 months. So that throughout the year, you're always checking your credit report just from a different bureau. So you can kind of keep on top of that. You're able to correct errors. So if you see any errors in your credit report, that could be incorrect addresses, incorrect names, incorrect trade lines, any of that stuff, you definitely want to contact the credit bureaus and get that taken care of. You might have, you might have to do some proving that something that's negative isn't yours, but it will absolutely be worth it for you. And the other thing is then you can kind of track down, do I have bigger problems that I need to look at? Is there fraud being perpetrated on my account somewhere that I really want to be careful and put a stop to? So who's responsible if you're mailed an unsolicited credit card offer and someone else gets a hold of it and applies for it? Well, I mean, technically speaking, just because they get the offer in the mail, they have to go through and they have to apply with your name, with your social security number, with your personal information. And they've got to kind of go through more hoops than just opening the mail. So I think that in the past, we sort of were led to believe that just having those things in the mail meant that somebody was going to open a credit card in your name. But it's a little bit more difficult than that, especially now considering how advanced the technology is and how easy it is for them to pull different things and check addresses and things like that. Now, that said, I started off this call telling you that I had somebody open, a credit application in my name, and I have no idea who it was or what the deal was. So I wasn't responsible for that. And with credit cards, especially, the fraud protection and the liability on those is pretty good. So anytime you have fraudulent credit card transactions, you're not responsible for those. You want to call the credit card company right away and let them know so that they can take those off, but you won't be responsible for those. And same thing if somebody opens a card in your name, and you find out about it and you say, hey, I didn't do this. This wasn't me. You're not going to be held responsible for those things. It is just going to be kind of a time suck and an energy suck. So unfortunately there's nothing really you can do about that aspect of it, but you shouldn't be held liable for any charges or anything like that on those. And then when it's time to rebuild your credit or you want to improve your score, the things that you can do to really help that, first off, automate those payments. You can make sure that your payments are getting paid on time every time by making them automatic. You want to obviously make sure that you're going to have enough money in your account. You don't want to try to automate your payments and then get insufficient funds or something like that. But typically speaking, if you can automate your payments, and like I said, with the credit cards, just minimum payments is fine, because then you can always go in and pay more, and that will supersede the minimum payment auto pay that you got set up. Your utility bills, same thing. If you can set up automatic payments so you don't have to worry about those, then you're not going to have any issues come up with that. Pay down your debt. So paying down your debt is an important way of increasing your credit score. There's some things that maybe you want to pay more attention to than others, but that's kind of a personal scenario that you're going to want to look at. I couldn't say always pay down this first or this other one first. I will say typically if you do have those really, really high interest loans, like a payday loan, that's absolutely got to be your first thing to tackle, because you're paying a lot of money in interest just for having that out. So typically when I encourage people to pay down debt, we look at the interest rate on things and say, what makes the most sense to, like you said, you want to make sure with those auto payments that you've got enough money in there that they're not going to pay overdraft fees or something like that because you're taking too much money out. If you need to contact your creditors to make sure that things are on the up and up, that's good. Sometimes you can call creditors, somebody that you owe, and work out a different payment plan. If you're struggling to make payments, you can say, hey, listen, I really want to pay this off. I can't afford this amount. What can you do for me? They can lower your interest rate. They can put you on a different payment plan. Sometimes with credit cards, they'll put a hold on the card. Basically, they'll cancel the card, but then they'll give you a much more favorable rate while you pay it down. So that could be one way to do things. We partner with a company called Green Path. It's a nonprofit that does this sort of thing, that works with people to do debt repayment plans. So it's the legitimate version of the things that you hear on those TV and radio commercials, where they're not going to promise you we're going to improve your credit score by getting rid of all this bad information. What they're going to do is they're going to contact the various places and say, hey, what can we do to make this right for this person? And they're able to help negotiate better terms, better payments, different lengths, that sort of thing. So if you're looking for that sort of help, I would say you can go to, I want to say it's greenpath.com, but definitely if you go to macu.com, our website, up at the top there in the menu, we've got a link that takes you over to Green Path. Like I said, they're free. I know, let's see, last year, I want to say that they helped our members pay back something like I think they helped our members pay back $1.2 million in overall debt to different creditors. And only like 60,000 of it was to Mountain America, debt that people owed. So they help with everything. They help with everybody. It's free to use. Really highly encourage you, if you're interested, to take a look at that. They're really great folks to work with, and they work with people nationwide. And then finally, if you've got a really low credit score, you can't qualify for a credit card. then you could get what's called a secured credit card. And secured credit cards are basically, let's say you want a $500 limit on a credit card. Well, you would walk into a financial institution and you would hand them $500 and you would say, I'd like to open a secured credit card. And what they do is they give you a credit card that works just like any other credit card, right? It's going to have a $500 limit, and you're going to go and you're going to put charges on it, and then you're going to get a bill, and every month you pay on that bill. And because they already have the $500, they don't need to worry about whether you're going to pay it or not. If you don't pay it, it's going to be reported as not being paid. But the idea is you're going to pay that over and over and over. And eventually you've proven that you've got a track record of making those payments. Then you can call and say, can we convert that to a regular credit card now? So then you won't have to front the money. But that's a good way to start to rebuild credit and rebuild trust with creditors, to show that you can make payments when they loan you money, or when you have that sort of a situation. All right, just last couple things here real quick. So know your rights. As a consumer, if you are denied for a loan, you have a right to receive a copy of the credit report that the lender used when they denied you. You can also see the credit score that they came back with when they denied you, and a list of reasons for why you were denied. So if they say we denied you based on lack of credit history, then at least you know what it is. If they denied you for high debt to income ratio or something like that, then you know what that reason is that you've been denied. So here's another myth for you. Collection companies are allowed to harass you and tell people that you owe money. That is not true. So collectors actually can't use threats of violence. They can't use profane language. They can't threaten to put you, out on social media as somebody who's not paying their bills. Those things are illegal. And if you hear about that, then you're going to want to make a complaint against that. So they can't. They also can't collect on a debt that you don't owe. So you can ask them to, send the information to you that proves that you owe that debt. They should have some sort of paperwork from the original debt holder that shows that it was transferred over to that company, and they're not going to have you arrested. Okay, there's no debtor's prison. They're not going to have you arrested for owing a debt. So if you get any of these, more cavalier debt collection companies, you want to go and complain at ftc.gov. Okay, so here's some of the information that we were talking about earlier that people asked for. Optoutprescreen.com. macu.com/greenpath if you want to go and check out Greenpath. Annualcreditreport.com. That's where you can go and get those free copies of your credit report. And then ID Protect or things like that can help you in terms of if you have issues with you want to get an alert or something like that. Okay, last two myths for this whole presentation. Number 9 is if you have a low credit score, you are in a bad financial position. And number 10 is if you have a high credit score, you are in a good financial position. Both of those are false. Your credit score actually doesn't tell anybody what kind of financial shape you're in. It only tells lenders whether you're likely to pay those bills. I have worked with people who have all kinds of money coming in and really high credit scores, and they struggle to pay the bills every single month. And I have worked with people who have, on the lower end of a good credit score, and they've got money in the bank, they have no problem paying things, and they have turned things around. So your credit score isn't really reflective in the grand scheme of things of your overall financial position. So if you're somebody who's got a high credit score but struggling, that's something you still want to fix. If you're somebody who has a low credit score and you're doing just fine and you just don't understand why your credit score is low, that's something that can be fixed too. That's not indicative of your overall financial position. So we've got some more resources for you if you want to go check out a couple of cool games and walkthroughs and coaches and things we have at macu.com/bonsai. Don't know if we set you guys up a custom one of those or not. That's something we probably could do, Bonsai. And then finally, I know I've met with several people already, and the rest of my team has as well. But if you want to meet for free one-on-one financial coaching with us, you can go to this link here, go.oneshub.com/fined, and set up an appointment, and we can kind of go through with you on a personal basis and figure out what we can do to move forward on your goals. And with that, we have just a couple of minutes. I think I hit all of the questions that came up in the chat, but if there's others about this or other topics, feel free to throw them out there and I will see what I can do. So our PowerPoints aren't available. Typically, our legal folks don't like us to leave the information out there because things change and they don't want it to come back to us. So I know that I think there was a recording available for this, and hopefully it can go out for a little while. Thanks, everybody. If you plan to switch banks, would you still recommend keeping the credit card open with the bank to maintain credit history? I would say it depends. The answer is a probably, depending on how important that particular piece of credit history is to you and whether there's any fees associated with it. So I would be loath to say keep open something that charges you a whole bunch of money just for the pleasure of having an account open with them, or requires a really, really high minimum balance. But that would be one, I might want to consult with somebody on that before I gave you a hard and fast rule on that. What is the best way to start building our kids' credit? Also, recommended age to start that process. There's a couple of ways. First off, when your kids are younger, talk to them about credit cards, especially. That's usually the first thing that people can qualify for in terms of getting a loan. It's going to be kind of the lowest hanging fruit. Talk to them about what good credit card usage looks like, what it means to be responsible with credit cards. When time comes, you can actually make your children an authorized user on your credit card, which will give some of your good credit history to them. So if you've got a good credit score yourself and good credit history, you can make a child an authorized user on that card, and that's going to show up on their credit report as an older account. So I actually I have a card from my parents that's in my name that I think goes back 35 years. So I would have been like 7 years old when that card was opened. I certainly wasn't opening credit cards at 7 years old. So it's kind of a cool way to help boost your history. How can you help an 18-year-old to build credit besides having a credit card? Well, the thing is, credit scores are really about loans. And so the only way to really, build a credit score is to have a loan somewhere. So they could take out an auto loan. So if you've got somebody who maybe you're like, hey, we're going to go buy you a new car, even if it's not a new car, maybe it's, a used car, you could go get a loan for that car. And even if you've got the money sitting there, you're just like, hey, I was going to go and pay $4,000 for this, this car. Why don't you go and put that money in the bank, take out a loan, and then pay off the loan consistently, right? So it costs a little bit of money in terms of the interest that you might have on those loans. But if you're doing it to build credit, then there's kind of an ulterior motive for why you would want to do that and why it might be worth it. Great questions.
Awesome. Well, thank you so much, Scott, for presenting to us today and answering all of our questions. I know personally I had a ton, so I really, really appreciate it. And we're so grateful to have this resource and this partnership with you guys as we continue to learn about our financial wellness, as that ties into our whole individual wellness as well. So thank you so much, Scott. We really appreciate having you on today. If there is any additional questions, you guys, please make sure to email me and I can relay that to Scott if you think about that later. But we hope you have a great day. Thanks again for joining our workshop series, and we hope to see you soon. Thanks, Scott.
Thank you.